Hello my fellow freedom builders and welcome back to the channel to a quick video where I just briefly look at the Broadcom stock with the ticker symbol AVGO. Now I did call this one a little while back and if you have followed my videos, and we are looking here in the swing trading portfolio on the positions, you can see that I just exited the Broadcom stock here today with a 3.4% profit. Now, why would I exit it now? And by the way, as you can see, I also sold the Capital One financials here with a couple of percent. Why did I exit it now? There are two different answers for that. So first of all, let's just have a quick look at the TPI on the AVGO here. Just a second. Comes here. The TPI right now, it's only updating once per day. So right now it actually looks fairly good. But if we are looking at the chart over here in TradingView, where it is live updated, it is falling a bit down, and you could say it's still holding this trend line, and yes it is. But if you're looking at the TPI on a live, when we are simulating that with the live data, we can actually see that the TPI is starting to look a little bit strange. Now, normally I would just keep this because it's holding this trend line, but I was actually looking to cut a bit off my portfolio, and that is due to this. I have put some TPI arrows in. I just put these on myself, and in the weekend I put a down arrow here on my chart of the S&P 500, indicating that it was probably time for S&P 500 to get a little retracement. And in situations like this, I tend to sell some of the stocks where I have 2, 3, sometimes 5% profit on, simply to trim the portfolio a little bit so we keep our drawdowns very, very low. That doesn't mean that Broadcom can't go up massively from here. That can perfectly be. But as you know, I am in my YouTube swing trading portfolio looking for some very low volatility, very low drawdowns. So I'm taking a lot of profits off, and I'm keeping my win rate very high. Now, if we just have a quick look at this, just have a quick look back at the AVGO here, Broadcom. Then we did enter it. If we just have a quick look in the portfolio, we can see what date we entered here. We entered it the 11th of July. So if we take a look at this, we have the 11th of July. That was somewhere here. So we entered it here, took a profit. It could have been a bit larger, the profit, but now we have taken it off with a couple of percent. So 2% in 3 weeks is actually quite nice. As I said, it can easily be that it keeps running. And if you want it to keep running in your portfolio, if you have it there, then let's try and have a look at if that is a good idea for a bit of a longer term investment. So if we're looking at the value chart, as we often do, we know that the PE right now is around 17. We can also see that the average PE is a lot higher than that. That is 38. So we actually need to go a bit further down. And in this case, I'll go all the way down to 1 year to have a look at, all right, if the PE keeps steady at around 17, 18-ish, and it might be going up a bit, but not much. So if it stays down here around the 20, we have a price up here at 90 something. And actually over the next couple of years, if the estimates are holding through and the PE stays around the 18, 20-ish here, then a fair value over the next couple of years would actually more likely be around the 800, meaning that Broadcom is not one I would buy now and then buy to hold for a couple of years. That would not be that interesting for me. You could maybe do it if you're selling some covered calls and stuff, but I think there would be better candidates for that. If we're zooming a bit out and looking at the longer term, as you know we do on the discounted cash flow model here, where we are looking at earnings per share, then you can see that if you want a yield at 10%, then over the next 10 years, the growth rate in earnings per share has to be 16% for it to be a fair value right now. However, if you're saying that the PE around 20 is actually fair enough for you, and you're saying I would actually be satisfied with 5% or maybe 6% in discount rate, well, then there is a big there's a big fair value margin of safety here, and we can try to bump this down to see what the actual growth rate in earnings per share should be, and that should be around the 10-11%. You can actually see it up here, 10.21% for the margin of safety to be in break even. So if you want a bit of margin of safety here, you might want to see 12-13% in growth rate in earnings per share over the next 10 years. Now you might say that right over the last 5 years it has been 23.8%. However, a large part of this is actually from the last 1 year rise here at almost 60%. If you take this 1 year out, let's just assume that that was 0, then we would lose 60% over the last 5 years. Divided on 5 years, that should be 12% that should be deducted from this. So let's just try and deduct, let's say 10% from this to try to mitigate this outlier here. 10% from this would be in the 10-14 range, and that is actually where we are saying that there is a decent margin of safety. So if Broadcom is in an industry and a sector that you think could be doing very well in the upcoming years, and if you think that the overall company possibly could grow its earnings per share by 13% over the next years, well then Broadcom as a long-term investment might not be a bad holding. If we're looking here at the summary, we can see that the quality and the momentum of the stock is actually great. The stock score is 86. If we are going down here, you can see the earnings per share growth. It is skewed by some very large ups and downs here. And actually it's estimating to grow 58 here and then only 7.6. If we are looking at the return on capital, it's quite good. Return on equity is outstanding. Operating margins are great. And looking at the PEG ratio, where if you follow me, you know I like that to be 2 or below. And if we look at the price earning divided by expected earnings per share growth, well then we get the 0.4, and that's actually a very decent number. We can also see that it is extremely safe. There is a very good Petrosky score, and we can see that the analyst estimates are actually up between buy and strong buy, and we can see that they have had some upgrades in the estimates. So overall, over the next 10 years, Broadcom might actually be able to pull off a 13% growth per year on average in their earnings per share, which makes Broadcom a decent investment if you will settle for 6% in yield per year. All right, that's all for now. This was actually just out of this a little swing trade, a couple of percent, could have been more, and those of you that hold it might actually see a leg more up here. But I am a bit nervous about the market. We are getting the non-farm payrolls on Friday, and it seems like the market is selling a bit off, taking some profit off the table. So right now I'm doing a bit of the same, and then I will always find some new swing trade candidates to go into if I have some liquidity to put into the market. That's all for now. As always, take care of yourself and your money out there. Remember to subscribe and hit the like button, and I'll talk to you again shortly. Bye.